According to the statistics published about inflation by John Williams, the price of gold here is exactly where it should be. And I can say, I'm not exaggerating, but say, I grew up with a gold price of $35 an ounce, okay? Until 1971. The gold price went then to $850 in 1980, and now it is, say, at 2,600, whatever. My view would be that the cost of things and services is up, say, around 10 times since year 2000. And the gold price is up about 10 times since then, a little bit less.
While the price is currently high, many analysts believe that gold's price is far from reaching its peak, and some experts predict that it could soon hit $3,000 per ounce or higher. If this upward trend continues, buying now, even at the current high prices, could result in significant profits in the near future. Renowned investment advisor Marc Faber, editor and publisher of the Gloom Boom Doom Report, discusses the new gold bull market. He contrasts government inflation figures with John Williams's shadow stats, emphasizing that while official data suggests gold is overvalued, alternative metrics show it is fairly priced today. Short-term interest rates, as reflected by one-year Treasury bills, bottomed out at 3.5% in 1971. By 1981, that same interest rate had more than quadrupled, rising as high as 16%. In that same period, the price of gold mushroomed from less than $200 an ounce to a previously unimaginable price of nearly $2,000 an ounce. Gold prices had a strong positive correlation with interest rates, rising in concert with them. From a technical perspective, Marc Faber delves into gold's historical cycles, noting its undervaluation in the late 1960s and 1998 to 2000, followed by overvaluation in 1980 and 2011. He argues that while gold may seem expensive now, it's a reflection of money's collapsing value. Gold holdings, valued at market prices, account for 15% of global reserves. Consequently, the share of the US dollars in total global reserves including gold would fall to 48.2% instead of 54.8% of global foreign exchange reserves. According to Marc Faber, the cost of goods and services has increased roughly tenfold since 2000, with gold prices mirroring this rise. He emphasizes that bank savings are no longer as secure as they once were, and suggests gold, though not entirely risk-free, offers a relatively safer option. Now we present the clips of Marc Faber's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
In the recent issue of my report, I discussed two charts. One chart was by the bank credit analyst, and they calculate the gold price in real terms. In other words, inflation adjusted, but inflation adjusted by the figures published by the Bureau of Labor Statistics, in other words, the government. I have been following for the last 30 or 40 years the conference board and also a fellow called John Williams. He has a website, Shadow Stats. John Williams is a decent fellow. He has no agenda. He doesn't belong to the Republicans or the Democrats in his views about the economy. He just is a brilliant statistician that takes the figures that lead to cost of living increases as they used to be calculated in before 1981 or 82. In other words, the old methodology. Now, according to the bank credit analyst, what is interesting is gold was very inflation adjusted, very depressed in the late 60s before the first big bull market in gold, 1971 to 1980. And then it became again very undervalued in the years 1998 to 2000. It became overvalued in 1980, inflation adjusted, and again in 2011, the last peak of the gold bull market, peak was, I think, in $1,941 or something like this. And then again, now it's very overvalued in real terms, according to the government statistics. But according to the statistics published about inflation by John Williams, the price of gold here is exactly where it should be. And I can say, I'm not exaggerating, but say, I grew up with a gold price of $35 an ounce, okay? until 1971. The gold price went then to $850 in 1980, and now it is, say, at 2,600, whatever. My view would be that the cost of things and services is up, say, around 10 times since year 2000. To buy a house and to go, I don't know, out at night and so forth. I think it's not totally unrealistic. And the gold price is up about 10 times since then. Someone will say gold is very expensive. In my view, that is true. It's expensive, but it's more a reflection of the value of money that has gone down, collapsed. And you understand, before I could say, when I grew up, my grandmother and grandparents always told me, Mark, you have to save money and put the money in a bank on deposit. I don't want to bore you with the story of my deposits in the Kantonalbank Obwalden in Switzerland, but it wasn't a good investment. But the point is, at the time, money in the bank deposit was safe. And nowadays, it's not safe. That people have to realize. What happened in Brazil a few years ago and recently in Cyprus can happen again. Whereas my gold in my safe, and I won't tell you where I keep it, in my office or the garden, but it is relatively safe, not 100% safe, but relatively safe.
Many analysts, including Marc Faber, discuss the impact of monetary inflation on society. He expresses that while some benefit greatly from speculation, others suffer as living costs rise faster than wages. The US dollar edged lower against the yen on Thursday after data showed signs of labor market weakness and a higher-than-expected rise in US inflation in September, even though prices were on a downward trend, allowing the Federal Reserve to keep cutting interest rates. Labor Department data on Thursday showed that the Consumer Price Index increased 0.2% in September. In the 12 months through September, the CPI climbed 2.4%, the smallest year-on-year rise since February 2021. Despite asset markets being at all-time highs, Faber predicts that the labor market is likely weaker than official statistics suggest. He believes the Fed may have cut rates to prevent stocks from falling, but warns they can't stop the dollar from depreciating, especially against gold and Bitcoin. Let's get back to the interview.
I've written about this because it's something that interests me. And it goes back to essentially the impact of monetary inflation on a society, because some people benefit from the monetary inflation. They become immensely rich and influential. And other people, they are impoverished because the cost of living is going up more than their wages. And they also suffer because when you can make money, big money out of speculating and speculations and speculative activities, it drains actually liquidity from productive sectors of the economy into the speculative sectors of the economy. So some people benefit from the monetary inflation and others suffer. The Fed rate cut looked probably at a labor market that is weakening or is far weaker than the Biden administration statistics would have suggested. That I want to point out. Because the labor statistics are statistics that are published by the government. Wall Street and the media then takes these statistics and they don't check about the validity of them, and they publish them because they don't want to destroy the inflated asset markets. But the labor market is probably quite weak. If they looked at the labor market, there was maybe a justification for a 0.5% cut. And I know some experts there, people who are knowledgeable about the economy. They think the Fed should have cut even more. This is not my view. This is where the distortion of the monetary inflation comes in. The labor market is weak, but the asset prices are in the sky. And to cut the Fed fund rate when the Dow and the S&P and the Nasdaq are all at all-time highs, and home prices are at all-time highs, and the Fed knows that the problem of the housing market is affordability. According to Goldman Sachs, affordability is at the lowest point ever in the US. That is a problem. But you understand, the Fed and Wall Street is about one and the same. They don't want to destroy the asset markets. This is a big concern about once you have inflated asset markets, you have to keep juggling them up. So they probably cut rates to prevent stocks from going down. But what they can't do is prevent the dollar from going down. And maybe it won't go down a lot against the euro and the yen. But it went down against gold, which is an honest currency. And it went down against bitcoins. So this is very complex. This is a very complex issue because if you look just at the labor market, maybe 50 basis point cut was justified. I'm not sure about it, but maybe. Some people argue it was justified. But if you look at the asset markets, there's a crazy to cut rates when the asset markets are in the sky.
In general, it is believed that the gold market will continue to attract inflows. With the US dollar weakening and gold maintaining its strength, is now the right time to consider gold as a hedge against further economic uncertainty? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.